Welcome to The World According to Boyer, where we bring top investors, best-selling authors, and business leaders to show you the smartest ways to uncover value in the stock market. I am your host, Jonathan Boyer. Today's guest is Patrick Doyle, Executive Chairman of Restaurant Brands, which owns a collection of well-known quick-service restaurant brands, including Burger King, Tim Hortons, and Popeyes. Previously, Patrick was CEO of Domino's Pizza, where he helped engineer one of the greatest turnarounds in restaurant history. During his tenure, he delivered 29 consecutive quarters of same-store sales increases, increased system-wide sales growth from $5.6 billion to about $13 billion, and most importantly, increased a share price over 23 times from nearly $12 in March of 2010 to $271 in June of 2018. Restaurant Brands was featured in a recent issue of Boyer Research. We're utilizing what we view as fairly conservative assumptions. We estimate that the stock is worth nearly $100 a share. Patrick, welcome to the show.
Thanks, Jonathan. I appreciate it.
Thank you for being on. And just to get right to it, with the track record I just described in the opening, I don't think job offers were in short supply. Besides being located in Miami, where you were moving, what made you choose to want to work with Restaurant Brands?
It's a terrific business. It's interesting because I really came at it as both an investor and as somebody who would be coming in to help run it. What I looked at was, number one, you've got 4 brands, any one of which I would have been happy to own. I like all of them. They've all got real strengths, things that I think can drive real value over time. And frankly, from an investor perspective, so there were things that I could see that I thought could be done that were going to create real value going forward. But also, frankly, from an investor standpoint, it just looked to me like the market didn't really understand where the 4 brands and 5 businesses were and how it was getting valued. You still had this hangover, I think, not believing that Tim Hortons was fully turned around. Tim Hortons is doing great. It's proved it with another couple of terrific quarters since I've been here, but the momentum was already there. Burger King, still lots of work to be done domestically, but I think discounting the greatness that is happening with that business outside of the US and already a good start inside. Popeyes and Firehouse, I think they have pretty well. Popeyes is a fabulous brand, fabulous food, good growth story. A lot more on that to come. Firehouse, pretty small part of the overall today. It's a couple of points of the cash flow of the business, but great food, great upside. The number one player in the category in some way has obviously been struggling a bit. So it helps when the biggest player has not been really on their game. So overall, I loved the value that I was able to come in at when I invested in the business, and I continue to love the upsides in each of the brands.
RBI is unique in it as a controlling shareholder in 3G. How did that help impact your decision?
In a couple of ways. First of all, I've known Daniel and Alex for some time. So we already had a good relationship. We've talked about a number of things over the years, and I'm very comfortable with them and how they view value creation. And us being aligned is obviously very, very important in what we're able to do over time. But the other thing that I think is really important is that having a reference shareholder like that, if they're viewing value creation the way they are, it allows you to make sure that you're taking a medium to long-term view on what's going to generate value. If you are a fully distributed public company, as a CEO, as a board, you're going to necessarily have to think about what short-term reactions are going to be. If you've got a reference shareholder like 3G, as long as you're comfortable that you're looking at things the same way, which I absolutely am, and it's why I agreed to become exec chair, you can take a medium to long-term view that I think is the right way to approach a business, the right way to be looking at investments in the business. I guess the best proof of that for me was to look at what they had already done with Reclaim the Flame for Burger King, which was a very significant investment that if you only looked at it short term, I'm not sure it makes sense. But if you're a shareholder who's in it for 3 years or 5 years or 10 years, it is clearly the right thing to do for the business.
I think 3G's treated somewhat unfairly in the press based on what you just said and other things. Why do you think the press has them as just cost cutting and that's it? Is there a particular reason?
It's an easy story to tell, but the reality is that they have shown a willingness at RBI to invest in things that are going to generate a good return. The way I think about it is you split the world inside RBI into two pieces, which is those things that you're going to invest in that are going to generate growth in the businesses, and those things that you need to spend money on just to run the business day in and day out. And the things that you run the business with day in and day out, they want to be very efficient and very lean. And I completely agree with them. What they don't get credit for is making the investments into the business that are going to generate growth. And they had done that with Reclaim the Flame. They've been making real investments into digital and IT. There've just been a pretty significant investment in Tim Hortons a couple of years ago to get that on the growth track that it's on today. They've shown the willingness to do that. And in my conversations with them, I was very comfortable that they were willing to continue to do that when it's going to generate a good return for shareholders.
Before talking about what you're doing at RBI, which is unbelievably exciting, I just want to briefly discuss what you did at Domino's, as the story is amazing. Essentially, during the great financial crisis, Domino's clearly was not doing well. Same-store sales were down significantly. And you and your team decided to create a marketing campaign where you spent millions of dollars discussing how bad your food was. But most importantly, I guess, how you were going to improve it. In hindsight, it was brilliant. But that seemed like a good way to ruin a career. What made you do it?
It's funny. So first of all, I will tell you, my wife was not a particularly big fan of it. When we were talking about what we're going to do, she's like, so what's plan B? And I said, well, probably I have to look for a job. It's interesting because I really believe that the biggest change with consumer businesses over the course of the last 20, 30 years is that brands used to be built based on what you said about your own brand. It was a one-way conversation. So Procter & Gamble can go out 30 years ago and create whatever truth around their brands they want to, because the consumer fundamentally has no way to respond to it. Fast forward to today, with social media, consumers are armed. They can respond. And in fact, the truth of your brand largely lies in the perceptions of the brand that are propagated and repeated on social media. And so the pizza at Domino's on an unbranded basis did fine. On a branded basis, it did not well at all compared to its competitors. We knew we had somewhat of a real problem, and we had a very big perception problem. Our view was, first of all, take the time, which was about 18 months, to completely reformulate the pizza. And then we need to go out and communicate this in a bold way, in a way that people are going to talk about it. And going out and telling people that your product is pretty lousy is a really good way to break through with consumers. And it caught on. So not only were we talking about it in paid media, but more importantly, our customers were all over it from the social media standpoint, and it changed views out there. It forced people to take another look at the brand, at the pizza, and clearly it changed minds, and sales were up virtually instantly. We launched it on a Monday, and by Wednesday, we were up double digit.
If it hasn't been, it should be Harvard Business School case study, but I have not seen thus far any other brand do what you did. And clearly it was successful, being honest with your customers. But how come no one else has copied your playbook?
It is a really good question. So the real answer is you'd have to ask everybody else in the world except me. I'm the one person who can't speak to that. So Harvard has written a case study on it. And it's interesting that it hasn't been picked up. The place where I would expect to have seen it by now was from somebody's political campaign, going out saying, hey, I've been part of the mess in DC. I own it. And I promise you, and hold me to it, I'm going to be the person who is going to do things dramatically differently than they have been done. And it would break through in a big way. I don't understand why nobody else has done it. I mean, you've got to have the right set of circumstances. We're not going to do it at RBI because the food at each of the 4 brands is not broken. There are things that we need to improve, but you've got to have the right facts. It's got to start from having a product that really does need to be overhauled. The question is for brands or products that are fundamentally broken, would it make sense to go out and do that? I suppose it could also apply to service, or there could be some other areas where business is really particularly broken and you decide, look, we're going to break through by going out and apologizing for the mess that we've created up until now.
You are now executive chairman of Restaurant Brands. You're not the CEO. And executive chairman, can mean a lot of things depending on the role. Basically, what are you doing on a day-to-day basis?
You're exactly right. Exec chair can mean a lot of different things in different companies. In my case, what it has been up until now is I came in to assess the strategy and the team to start with. Are we doing the right things in these businesses, and do we have the right people doing them? Our new CEO, Josh Kobza, is terrific. He was appointed in February. He's doing an amazing job. I am thrilled with Josh in the business. A lot of the businesses, though, were already very much on the right track. And the most important thing that Josh believes in strongly, and I completely support him on this, is these are big businesses. So fundamentally, we've got 5 presidents here. We've got 4 who run the US and Canadian business for each of the 4 brands. And then David Shearer, who's based out of Switzerland, who runs all of the businesses outside of the US and Canada. And we've got really good leaders in those businesses, and we need to give them the rope and the room to run their businesses and move fast on the opportunities that they're seeing in their businesses. And I think generally it means probably more resources in the business and probably fewer resources within RBI at the corporate level. Giving them more freedom, pushing some of those resources down into those businesses so that those 5 presidents can move more quickly. My job has been, up until now, looking at the plans, looking at the strategies for the businesses, making sure we've got the right people on those businesses. And then increasingly, it turns into a job of mentoring those leaders, both Josh and the 5 presidents, giving them advice and input on the businesses, helping them on some things more directly, but very careful to, as I just described, giving them more autonomy to run their business. I'm not going to try to run their businesses. And frankly, Josh isn't either. His job as CEO, he is running the company day in and day out, but his job is to push and prod and find areas where he thinks maybe things could be getting done better, coordinate some of those things where we think the scale of RBI can drive some real efficiency in those businesses, but then let them go after it. So once we've got the strategies all dialed in, my job becomes more and more about advice and mentoring those leaders and leading the board, obviously, as well as exec chair.
Can you just give an example of advice recently that you gave one of your leaders, just to get a flavor of the type of things that you're doing?
Probably the most common thing that I've found myself talking about is just going faster. I am sure every executive winds up feeling this way at some point. I still think that I'm the young, smart guy who's figuring things out really quickly. That's not me anymore. I got a couple of decades of experience in now. And the big advantage from that is speed. The depth of talent at RBI is extraordinary. There are a remarkable number of really motivated, smart, capable people here. What I bring is, because I have done some of this before, I look at some of the initiatives that have already been underway, and I can just very quickly look at them and say, that's right. You don't have to worry as much as maybe you have about, okay, let's stage gate that, make sure that we're hitting the metrics and that all of the analysis that we put into this is correct. I can give them real confidence on, yes, that's correct. Let's just go faster.
One of RBI's biggest brands is Tim Horton. And for people outside of Canada, it's really hard to understand how big of a brand it is within Canada. And one of the stats we noted in our report on restaurant brands is that Tim's app is the second most used e-commerce app in Canada, with I think about 4.3 million monthly active users. Do you think Wall Street undervalues the brand equity that Tim has?
First of all, because it's almost impossible to overvalue the brand equity they have. It is extraordinary, and it is essentially unique in the restaurant industry in terms of the love that consumers in Canada have for that brand. It unironically uses the maple leaf. It uses the flag of the country as its logo. It's pretty extraordinary. And I think the statistic is that about 80% of Canadians have been in a Tim's in the last 30 days. In my old life, a good customer was about once a month. At Tim's, you got a lot of people who are once or twice a day. The frequency and loyalty on that business, on the brands, the trust in that brand is just remarkable. And there simply isn't anything like it in the US in terms of the depth of the brand strength that Tim's has in Canada. And our challenges at Tim's are to figure out, how do you continue to extend that brand strength in Canada? And then how do you expand it around the world? And we're well on the way on that. It clearly does not mean as much in the new markets as it does in Canada. So our job is to figure out, okay, how do you take that brand, translate what it means in Canada to people outside of Canada? Off to a really good start, but that's the big challenge.
You mentioned earlier in the interview that you came in this as an investor and you put a substantial amount of your own money into restaurant brands. When you started earlier in your career, you worked at Gerber Canada. So presumably you spent a lot of time in Canada. Did that give you, as an American, a unique insight into how powerful Tim's was?
I think it did. So yeah, I lived in Canada for a couple of years. My oldest daughter was born up there and is proudly still a dual citizen of Canada and the US. What I will tell you, and that was stunning to me, is I was up there in the mid-90s, and it was already an amazing brand. It has fundamentally doubled in size since I lived up there. So it is even bigger, even stronger, even more beloved today than it was. And the people who owned and ran that business, Ron Joyce and Tim Horton himself, Tim sadly passed pretty early in the run of the business. So really it wound up being Ron Joyce, who was running it for a long time, and then Paul House. And the two of them did a really remarkable job with the business. It had a few pretty tough years. And then Axel and the current team up there have been running it for 3 or 4 years now and have just put it on a remarkable path.
I understand it's on a growing trajectory. You open your 600th store in China. It's 25% of your recent new net restaurant growth was from Tim's, but it's still not even close to the dominance it has in Canada. Is that something that is possible? Can you get 80% of the way there? How is that done?
If we can get 50% of the way there, we'll have tens of thousands of restaurants outside of Canada. What Tim's has that is important, I think the Canadianness is important, but it's how that translates to consumers. And what I think Tim's means to people, both in Canada and around the world, is that it is just a good, honest brand. It is what it is. It's not trying to be fancy. It just gives you good product, good value for money. They're doing some really interesting work up there in expanding it into even more of a total beverage business, as well as expanding day parts later in the day. But there is something about the brands and the essence of the brand that is very much reflective of how people view Canada and really how Canadians view themselves, which is we're going to be straightforward and honest and give you a fair value for what you're buying. We're not trying to be fancy or anything about what we're doing. It's just going to be good, honest beverages and food. And what Axel and the team have done in the last few years is upgrade the quality of the food. They went to fresh cracked eggs, which I think was really, really important in upgrading the quality and the perception of quality. But it also just adds to that. Look, if we're going to give you a bagel with an egg on it, it's going to be an egg. It's what the brand is and what it means to people. And I think there is a way to take that and make that work everywhere.
You've talked about the opportunity with Tim's as almost the reverse of the opportunity that McDonald's had a few years or more than a few years ago when they essentially created a whole new category, which was breakfast. Tim's primarily serves coffee and donuts, and that's great in the morning, but less strong in the afternoon and evening. So you want to change that, which is great. How do you do that? How do you get people who are accustomed just to come in the morning to go there all day?
The great news is it's pretty efficient to be able to do that. When they're coming in the morning, you can communicate with them about what will be available if they come back later in the day. And they already know where we are. It's already a habit for them. We do advertise it on television, but what's interesting is if you've got people who are using the Tim's app, and you talked about being the second most used e-commerce app in Canada, well, that means they've already got it there. So it's very efficient to go back and communicate with that customer and say, we've got a loaded bowl that will be great for you for dinner. Both awareness, driving awareness of our offerings in later in the day parts, but also giving them offers to do it and to drive trial. And it is very similar to what McDonald's did a long time ago. And I am sure that there were people when McDonald's started talking about we're going to drive breakfast, we're looking at it saying, you guys sell hamburgers and French fries. How can it possibly make sense for you to go into the breakfast business? And the answer is because McDonald's, the brand strength that they had, the ubiquity and availability of their restaurants, people already knew where they were. It actually wasn't that hard for them to go into a new day part. And the beauty of Tim's is there are almost 3 times as many Tim's per capita in Canada as there are McDonald's per capita in the US. With the strength, the distribution we have, customers already knowing us, doing business with us, feeling good about it, getting them to try us for something else during the day is, I think, relatively straightforward. The team is doing a great job on it.
In the bull case scenario for Tim's, if you execute, can this become Starbucks?
I hope a lot more than Starbucks. In terms of what it does, Starbucks is a terrific brand. And obviously, the growth globally has been extraordinary with Starbucks. But there are ways in which the Tim's brand, I think, is a broader brand than Starbucks. And so I think there's an awful lot that we can do with this brand over time.
So if that is true and that happens, Tim's could be eventually worth more than the entire current enterprise value of RBI now.
That feels a lot like a forward-looking statement. But do I think that the brand strength of Tim's is extraordinary and something that we can build a really big business on over time globally? The answer is absolutely yes.
RBI is essentially an all franchise business, which means you make your money on franchise fees. So who do you view as your customer? Is it the franchisee or the person buying the Whopper or chicken sandwich?
I always have to be careful when I say this because, look, at the end of the day, what really matters is the customer base, the consumer, how they feel about Popeye's chicken sandwich or the cup of coffee they're getting from Tim's or the Whopper or the hook and ladder from Firehouse. But as a franchisor, we do have to decide, where are we going to focus? What is most important to us? And the answer to that is it's the franchisee. And ultimately, the product that we sell, putting air quotes around that, is the unit economics of the restaurants that our franchisees have chosen to invest in, whether they built it or they bought it from somebody else. And ultimately, our success as a franchisor is going to be built on the success of the franchisees. It's a really easy product to measure. It is, what did they spend to build it and how much cash flow is it generating for them as a result of the investment that they made? And so, you know that the first quarter I was here, we started releasing the cash flow by brand in the home markets. That I truly believe is the most important measure. If we are improving that, I think investors in RBI stock can build confidence in what the future is going to be of this business, because ultimately that's what's going to generate more restaurants being built, because the franchisees know that the returns they get are good and that the trend is that they're getting better. And if they've got continued confidence that they're already good enough and that they're going to get better, then you're going to get more capital coming in, more great operators coming in to run those restaurants. And they're the ones who ultimately take care of the final consumer.
So Burger King International, it's really running on all cylinders and it's doing great. Burger King US, as you put it, is a little bit of a fixer-upper. Intuitively, it would seem like it would be a lot easier to sell hamburgers in the US than in Europe or Asia or whatnot. Why is one working so well and one not so well?
It's really interesting. And I will tell you, it was the same issue at Domino's. The international business was better sooner at Domino's than the domestic business was. Sometimes it is a benefit to have a smaller scale business, and a master franchisee is occasionally quicker to adapt to things than the home market may be, which is just that much bigger. That is very clearly the case in Burger King. So outside of the US, we are a far more digitally forward business today than we are domestically. There are many markets where 100% of orders inside the restaurants are digital over kiosks. The assets are generally in better shape, meaning the restaurants look better. Outside of the US, some of that is just simply age, but they've also, I think, more consistently reinvested in them. The food is great in the US, and they've taken the great food, the Whopper in the US, and I think done some really interesting things to adapt it locally in some of the international markets, all of which has led to, on average, better returns on those restaurants. So more have been getting built, which means that there are more advertising dollars every year to promote the brand and the business. And you get into a virtuous circle and you're attracting great operators. It just feeds on itself. And in the US, we've got a lot of really good operators in the US, but we have had some that haven't been as engaged. We had a number that had taken on too much debt, frankly, combined with our average returns not being high enough on those restaurants, and they had gone backwards during the pandemic. So shame on us for letting it go the wrong direction on average results. Maybe shame on some of them for having put a little too much leverage onto some of those larger restaurant groups. So we've got some things that we've got to work out of. And all of that led to then a, frankly, inability to reinvest in the restaurants the way they should have. So some of the restaurants are older than they should be and have gone longer without a refresh. All of those things start playing. And then that means your advertising dollars aren't growing the way they should. So you got to turn that around. And that is what led to the Reclaim the Flame program, which was the company is going to step up. We're going to get the momentum going the right way again. We're going to get better engaged with our franchisees. We're going to work through some of these tough situations with franchisees. We're going to invest in more advertising dollars. We're going to put some matching dollars around getting some restaurants refreshed and reimaged. And that gets the momentum going again in the business. And a reminder again, I had nothing to do with that. That was all done and in place and already getting executed before I got here. And you can see it. It's playing through quantitatively in the numbers and qualitatively in our franchise system and our team that runs Burger King here in Miami, getting more and more aligned. We've got a lot of work to do. It's going to take time. We've got to continue earning our way here in Miami. We've got to continue being smart about how we promote the brands, how we price, all of the things that we're doing as the franchisor need to continue to be smart. We've got to generate a better average business outcome for our franchisees. They're giving us credit for the effort. I feel good about how the trust and relationship is growing. And it's probably more on us to continue to prove that for a while. And I give them credit for hanging in there, working through what was not an easy stretch. They're seeing the results going, and hopefully that builds some real momentum around the brand and the business, and that continues to feed it.
One of the competitive advantages you said that you have is the Whopper. You've actually said it has more brand equity than Burger King itself. I was kind of curious what you mean by that.
It's incredibly well known. The Whopper itself is viewed as a very high quality product, a great, better burger. It is true, and we're given credit for that by consumers. Today, look at the sales results of the last few years. We have not been given that credit on Burger King overall. What we've got to do is turn that into full credit around all of Burger King, and that the total experience and whatever you're buying from us is viewed as being great. But the base on that has got to be to continue to grow from that strength that we've got with the Whopper.
So how do you do that?
I think there are a lot of things that we can continue to do with the Whopper to grow it. So that is going to be part of it. And if you've seen any of our advertising,
It's hard to miss.
it's not subtle about driving what we think is the true brand asset here. And then we've got to make the rest of the experience every bit as good as it is when you get a great Whopper. So that means service needs to improve. It means our restaurants need to get refreshed and look better. We've got to do things with the whole menu to make sure that everything is as good as the Whopper is, that the experience the customer gets is as good as the Whopper is, that the restaurant looks as good as the Whopper is. When we've done all of that, then I think the Burger King brand becomes as good as the Whopper brand.
I saw that you've been on Jim Cramer's program multiple times. They've been really cool appearances. Just what was it like being on that show?
Jim has been really, really kind to me over the years, and to Domino's, and he's getting behind RBI now. Jim is an incredibly smart guy. He's a really good interviewer. I love it. I love interacting with him. And frankly, it's an interesting thing. I've had different leaders talk to me about the process of presenting their business case and their company to investors and how they react to it. And some love it and some don't. To me, the real value in talking to you today, in talking to Cramer, in talking to investors and to analysts, is it often makes me think. It's a funny thing. There are people who do really well figuring things out on their business by going into a room and closing the door with a clean sheet of paper and thinking through their business and what else can we be doing and where are the opportunities. I think best by talking about things. Go back to Jim. Often when Jim has pushed me on things live on air, I'm thinking about it going, That's an interesting take. I wonder if we're missing something there. I give him credit for pushing on something. And so anytime I'm out talking about RBI and people are asking me questions about RBI, and it helps me to think about the business and the plan. It helps me further my own thinking on it. And Jim has helped me a lot with that over the years.
Besides being executive chairman of Restaurant Brands, you're also chairman of Best Buy, which is another great brand and a great retail store. Can you contrast your role there with your role at RBI?
Sure. Yeah. I mean, it's very different. I'm not the executive chair at Best Buy. So Corey is a phenomenal CEO. I am just a huge fan of hers. It is a very different role. I mean, I'm there for board meetings. I'm there when she needs me, but I talk to her regularly, but certainly not daily. It's a pretty different thing. I don't have a desk at Best Buy. I'm physically there generally only for board meetings. And so I'll have conversations occasionally from a distance, but it's a very, very different thing. As executive chair, right now I'm in the office basically every day when I'm not traveling for something related to RBI. And so very different level of time commitments there. I run the board and I'm there as a resource for Corey, but I'm nowhere near the day in, day out of the business. Here, I'm in the office. I'm more deeply involved, going down particularly to the 5 business unit presidents. I have a lot of direct conversations with them. But over time, as Josh is more and more settled in, and I'll tell you, he's getting there really fast. He's brilliant. He's doing a great job. Then there's a point at which I got to back off a little bit and give him the space to run the business day in and day out, which he's already doing really, really effectively. But big difference between being an executive chair and a non-executive chair.
Why did you decide to go on the board of Best Buy in the first place? Was there any particular reason?
I went on the board there almost 10 years ago now. I think it was 2014. There were a number of reasons. So it had been going through a turnaround. It had had a rough stretch. Hubert Joly was still the CEO when I joined the board. And I thought that there were things that I could add as they were thinking about particularly how the digital was going to affect their business. And they're now about a third e-commerce. It was also about what I thought I could learn. Anytime you're on a board, it's always going to be about both. What can I add to this business? How can I help them be better? But also, what am I going to learn? If you're very focused on what's happening in the digital world, being on the board of the leading consumer electronics business, retailer, service provider out there is going to give you a lot of insights into where consumer behavior is in consumer electronics, how they're using devices, how that's predicted to change over time. And that helps me in my day job with RBI.
Patrick, you've been unbelievably generous with your time, and it was fascinating discussing your career at Domino's, what you're accomplishing at Restaurant Brands and your vision of it, and even talking about Jim Cramer. I just want to thank you for being on The World According to Boyer.
Thanks, Jonathan. I really appreciate it.
I hope you enjoyed the show. To be sure you never miss another World According to Boyer episode, please follow us on Twitter @BoyerValue. Until next time.